Welcome everyone to this edition of The Closing Bell. Jason Jacoby here with Mark. How are you doing today, Mark?
Great, man. I'm doing well. Yeah, I'm doing good. Looking forward this weekend to. I got an air show. I live in Huntington, right? You going down to the air show? They got these
Hopefully.
F-15s and stuff just buzzing over my house. I'm like, what? They brought it back, so it's pretty fun. It's a fun event,
It's
but
pretty
it's
crazy.
really loud.
It's
And
crazy.
my dog Kiki, Kiki, right? So she's just going nuts. I got to stuff her, get her in the garage and try to. Yeah, it's pretty traumatic for her, the noise, but yeah, it's fun. Going to be a fun weekend.
Yeah, it's definitely, if people haven't seen it up close and what we're talking about, right? It's kind of like the old Blue Angels, back in
Yeah,
the day. And I know they're still around too, but basically you're getting these like you said, F-18s, F-16s, F-22s, I think all these
crazy.
different types of fighter jets, and they're buzzing over your head, like within a couple
There's,
hundred feet.
and really, and so loud. A few years ago, yeah, just quick, like Jana had something in the oven or something. It was like sort of hot, a glass dish, and it literally, this plane came over our house, and it shook so much that it literally broke the dish in the oven. It was crazy. I mean, that's how.
Sheesh.
So it's like the power behind those planes is amazing. So
I always
sounds scary, but it's pretty fun. It's so USA. I love it. It's pretty cool.
I
Yeah,
can't imagine being on the receiving end of that though. Like, you see those things coming, you're like, well, I'm saying my goodbyes now, my last prayers, and
yeah, they're
it's
upside down.
over. I mean, those, like you said, those things are so powerful, but we got a lot of good info for our listeners today. We'll get right into it. Again, this is podcast format, so you can listen to it on Apple, Google, Spotify, audio versions, or you can go on our website and watch the videos or YouTube. Highly encourage you to, because again, we have a lot of really good info. It's going to differ from the newsletter slightly. We're going to hit on some kind of macro topics and things we think that you're going to find interesting for the week. We're not going to cover every single section in the newsletter. So read through it. If there's something interesting, great. But again, this is going to be kind of more of our opinion, insights, and hopefully it's a little educational and entertaining for our listeners today. So let's get right in. So we got the global markets, right? So we don't just talk or invest in the US, we invest globally. We're global investors. Obviously, we love the US of A, and we think that free market capitalism and what's going on here in the US in terms of growth and innovation, the U.S. stands at the forefront. We're the light on the shining, or the shining light on the hill. Almost
Yeah,
misspoke
light
there.
on the hill. That's how we were established many years ago. Yeah, so it's pretty cool, and that's why I love about, back to that air show real quick. It seems so pro American. I love it. So
Yeah.
it's really fun. So yeah, we live in a great country. And I
So
don't think in our culture anymore that we're really celebrating that as much as we should be, for sure.
yeah, absolutely, absolutely.
We are
So
blessed to be here.
yep, we are very blessed. So getting into kind of what's going on across the world, this chart's just showing you, giving you kind of a bird's eye view of the week in the markets, everything so far at the time of recording here at 12:40 p.m. Pacific time. Markets are down not only for the week, but obviously this month, September. The chart that we're showing here on the screen, again, you've got the S&P 500 in blue. You've got the UK, so the United Kingdom's FTSE 100, and that's kind of like their S&P 500 over there. That is in kind of like an orangish gold color, the lighter kind of mustard color. And then
Mhm.
we got the Hang Seng, which is the index for Hong Kong. And I always butcher this, the Nikkei, however you pronounce that, Japanese index, kind of their main index that we look at as a market barometer, what's going on over there in Japan, Tokyo, in green. And then following as the Euro stocks, which is like the Eurozone's version of the S&P 500. It measures these top 600 companies over there. So again, a lot of overlap here, but again, kind of gives you a heartbeat of what's going on around the world. Markets, ending in the red for the most part across the globe. But again, I think the thing what I want your opinion on here, Mark, on this month. So let's talk about historic September. Give us a little insight into why September is historically known as a bad month for the markets.
Yeah, I mean, I think there's a number of reasons. One is, earnings reports are pretty much done by in August, so you don't have a lot of news other than
The normal ones.
what's
Yeah.
kind of happened through the summer. I joked on our last call, maybe it's just going back to school, it's kind of back into the routine after a summer, people vacation's over and they're all in a bad mood. I don't know. It could be part of that.
Yep.
Um, it's weird. It's interesting to see how it works out and plays out typically. And then, September, and then in October, everybody's afraid of October. It's kind of funny. You could say, well, we had the big sell off in 87 and, those times where October's ugly, but it's also known, October also is also known as the bear killer, to where
Yep.
you have a bad September and then, you start to see a rally. September, October, November, October, November, December into an end of the year is traditionally, you actually been very positive over the years. So, yeah, I mean, I think that it's just part of it. It's cyclical, and markets go up, markets go down. We've been talking about this for a while in regards to, we had a big run. It was very narrow this year, and you look at this, and so not unexpected. We're having some pullback in here, and that's normal. I know we're going to talk about that. Pullbacks are normal, and then in regards to international stocks, I think it's really interesting because you see international, which is really interesting. I've grown more and more bullish on the international piece here. Just in regards to valuations of stocks, especially international. I mean, are just very attractive. I mean,
Hmm.
obviously very pro U.S. and this is where everything happens. But there's also great companies that are outside the U.S. that are trading at good valuations in comparison to our market. So there's some real opportunities there. But then the dollar's been rallying in here, going higher,
Yeah.
and so that's always sort of a headwind to international investing, because as the dollar gets stronger, the when it comes back into dollars, you get less, you just hurt your returns on the international side. So, but, again, it's all getting set up for I think, some bullishness into the end of the year.
I like that. There's some good insights in there. And I like what you said, just in terms of markets being cyclical. Again, we're up for the year, September, just so we can give our listeners or watchers here kind of a synopsis. So the Dow is down about 3.77% at time of recording here for this month. S&P is down 4.5%. Nasdaq's down over 5%, and then the Russell 2000, which are your small cap companies, are down over 6%. So again, that kind of gives you a grassroots vision of what's going on with the smaller companies in America. Obviously, with higher inflation, higher borrowing costs, those companies have a harder time to do business in the near term. So again, watching that, but I like the international piece that you're talking about again, and you and I, countless conversations, right, about obviously having great companies. We've done podcasts on those, or mid-year outlooks on those companies that have kind of have a global earnings or global revenue streams, excuse me. And again, that international piece with a strong dollar kind of provides those headwinds. So with inflation ticking down overseas, German inflation has come down, even though they're in a technical recession right now. The UK inflation, which obviously they're very dependent on Russian oil and foreign oil, more so than us at this point, but inflation's come down quite a bit. I think they're down in the fours now, as of today. So again, the numbers are ticking in the right direction for them. So that could spurn a little bit more economic growth potentially, or chances of soft recessions if they're not in a technical recession. So I like what you said there. But let's talk a little bit more about market corrections. So, I mean, you've experienced a lot of different markets. So give me some wisdom here. Give us, our listeners, some wisdom on when's a good time to invest? Is it now a good time to invest? What do valuations mean? How do we decipher what's going on here?
Well, I mean, again, when you're investing, the key is to have, a balanced portfolio. That's what we preach here, is having what we call an all weather portfolio that basically helps us in all types of scenarios. Um, you want to always have a portion of your money that you think is shorter term. If you're investing, like a trust or your individual money, or if you're older and you're needing money, then you want to have enough funds in more safe, cash like or fixed income to be able to handle, what monies you need in the next 3 to 5 years. And so as you build out a portfolio, that's the portion that you invest in those areas. that are a little typically more secure. And right now, what's great about it is, for the first time in a long time, we actually have yields to play with. You're talking about 5% returns in money market funds and different places that we haven't had for a long time. We've talked about that on prior webcasts here that we've done. So that's huge, and yet so a lot of people, I just heard another number today is over $6 trillion now in cash in the US, and over 10 trillion, excuse me, worldwide in cash, which is the baseline is normally in the US 2 million. So you got 2 trillion. So now you got $4 trillion, that's not normally on the sidelines
Yeah.
in cash, but that'll be put to work. A lot of people are talking about that. When's that going to be? There might be a window of opportunity here in the next 6 months to go out on duration. But all that said is that, corrections are going to be there. You have to stay with your plan. You got to, stick with it through dollar cost averaging. And again, looking at your portfolio on a regular basis, making sure you just got the right allocations in the right spots. And I think that what I've learned in my many years investing is nobody knows what tomorrow is going to bring. Nobody knows what next week. I mean, you could say, the smarter people know things. No, I've heard anybody who's ever been in this business knows that nobody knows what's going to happen tomorrow or next week or next month. But you can make pretty good decisions going out longer term that, that stocks are our best performer, 7, 8, 10 years out plus. You want to be in equities. And so that's what, as we talked about, you build a portfolio around those things. And so, you just have to expect, if you're going to be in the stock market or you're going to invest, you're going to have periods where it's not going in your favor. But those are, again, where you have to keep your emotions out of it and stick with your plan and be looking for opportunities to even add more when things pull back. So, right now the bond markets the yields are just going higher. We'll talk about that here in a second. Right here, you'll see it. Traditionally, what happened in 22, being a one-off year in 40 years, it was the worst bond market we've ever seen. And typically in a 60-40, traditional 60-40 portfolio, you get, you buy bonds in order to offset volatility in stocks. Well, last year was just with the amount of increases that the Fed was doing and what the bond market reacted to and how slow they were, we got a huge increase in yields that causes bond prices to come down. So, there you go. I mean, and now recently, last week? Yeah, when the Fed went out, Powell talking, is talking about now that the Fed is looking, finally, we've been talking about it being, higher for longer, right? So now they're finally figuring it out. And so they say it, out loud. And the Fed, you look at the dot plot, what we talked about last week, it looks like they're all thinking it's going to be higher for longer now. And so now you see the 10-year yields that kind of broke out here recently above prior resistance. And so, looks like the 10 years could go anywhere from 4.7 to 4.9, so, that puts, as yields go up, that's good news for new investors and new bonds and new issues that are coming out. But if you hold a bond and the yields are going up, it actually reduces the price of your bond in the near term, as far as liquidity goes. And so it's an inverse relationship there that hurts the bond market. So, so it's been really interesting. All that to say is that you just got to keep an all-weather portfolio and don't let your emotions get out of control.
Yep. And just dive a little bit more into bonds and how they work. Obviously, you just mentioned open markets. Bonds can be bought directly from the Treasury, right? From Treasury supply when they issue new debt, obviously at higher interest rates. But they also can trade in the secondary market. So let's use an example that we talked about a little bit earlier. But let's say you're the U.S. Treasury and you're issuing bonds right now. Let's use this example from the chart. 4.65% on the 10-year. If I'm an investor that's holding a current 10-year Treasury bond, and I'm like, oh man, like I need to get out. I need to sell. I need some cash. I am going to have to discount my bond coupon, which is attached to the bond that you buy. The interest that it pays might be 3% or 2% if I bought it 2 years ago, right?
Yeah.
A lot lower. And inflation's a lot higher now. So I'm actually negative cash flow. negative return, total return with that bond. So I am going to have to discount my bond if I want to sell it to, let's say, Joe Schmo down the street. He's
Mm-hmm.
like, well, why wouldn't I just go to Mark and buy a 4.65% 10-year T-bill or treasury bond, excuse me. How are you going to entice me to buy your bond? How are you going to make it more attractive? So that's when I have to discount my bond. It could be 90 cents on the dollar or
Yeah.
whatever it may be to make my bond more attractive to gain that total return. It might not pay as much interest, but if I hold it to maturity, at maturity, you get back par, which is usually
Yeah.
$1,000.
Yeah. So it does.
I might sell it for 200, so that the investor might make $800 on just the capital side by buying it at a discount, plus the 2-3% interest that he'll accrue each year, depending on how the bond's paid. But hopefully that made sense to investors. But again, that's the give and take. That's why the bond market was so bad last year, like you had mentioned, right, Mark? I mean, it
Yeah,
was
no, and we
brutal.
talked about there's an inverse relationship, Sue, and you explained it very well. I always just like put up a pin, and you just say, when yields are low, and as they go up, if you have one side that's yield, the other side is bond prices.
Yep.
As as yields go up, the value of current bonds actually goes down because of that. Just what you said. If I'm sitting on a 2-year coupon, and now they're at 4.5. I got to really discount the par value of my bond in order to entice somebody to buy it. So, yeah, and if you hold it to maturity, like you said, you're going to get what you bought. You'll get your 2%, in 10 years, and that's great. But now that, like you said, we're up and above, 4.7. We're up there pretty high, right?
Yeah.
Like 4.6 or so, and well, that's or 4 point. I'm sorry, four. We're in that area. Was it
4
4.54 today?
4.65. Yeah.
Yeah. Let me just see here. I'll pull it up. Yeah, 4.5, almost 4.6,
Yeah.
4.57 right now, currently in the market, and so you're going to have to entice me to get me to take your 2% bond. You got to like you said, really sell it at a par, but
Show me
or
the money.
high discount to the par value.
Yep. Good point. Good point.
Yeah.
All right. So, corresponding with that, so we talk a lot about interest rates. Obviously, with higher inflation, higher oil costs comes higher yields, right? So, the PCE indicator, the personal consumption expenditure report, came out today, Friday, and that measures inflation. That's the Fed's preferred method of gauging inflation in our economy. So we're going to kind of go over that, and we'll talk about kind of, again, we've talked about this last week on our podcast, but we'll kind of dive in and get your thoughts here in a second. But month over month actually came in line with expectations here. Again, was up 0.4%, 40 basis points. It's double the 20 basis point increases we saw in the previous 2 months. Obviously, again, with higher fuel prices and sectors, it's the highest print we've actually seen since January of this year, which was 0.7%, 70 basis points.
Mm.
And now getting to the year over year, I like the year over year numbers. And again, it just shows kind of where we were at last year comparative to this year. And, we observed a little bit of a surprise. It was a 3.5% reading, which is 20 basis points higher than expected. And then it's the highest figure we've seen since May and follows the upwardly revised 3.4% that we saw last month. So again, 3.5%, not at the Fed's target of 2%. You can talk about that in a second, why that might not be attainable anytime soon. But core PCE, again, strips out food and energy costs, which I hate when they do that. But again, it kind of shows a little more of a stable inflation picture in the core of the economy. And that one came in slightly lower than expected at 0.1% year over year. And it's dipped below 4% for the first time in 2 years. Whoop-de-doo. Whoop-de-doo. So again, we're trending in the right direction, but why don't you
Yeah.
talk about the realistic nature of us getting down to 2%? I mean, that seems a little bit of a stretch, right?
Yeah, it's not going to happen. And we've said that over and over the last. I just don't think it's going to happen. If it does, it'll be. If we get to that place, I think that, especially in the near term, it'll be for not a good reason. It would be disastrous in a way. I think that that would be a really, yeah. I just don't think it's possible for that to happen. Again, we go back to long-term history. 4% is more of a 100, 80 to 90, 100-year average. And I think
Mhm.
that,
Yeah.
you revert to the average. So, that's where we're at. I think that's where it's going to be. And I think the Fed kind of said that last week. I mean, I think that they're saying that, they still have this target out there, but they're kind of easing up on that. It sounds
Hmm.
like, and kind of bringing that up a little bit, the more realistic number. So, you know, I, I think that that's kind of in the cards, and I think everybody knows it. Look at inflation's going in the right direction, or has been. I think
Hmm.
overall, I think the
Yep.
market feels like that. Most experts that we talk to, and you and I have been on some calls with some people that are really sharp on this. They feel like, it's not going to, there's not going to be a lot more rate hikes, and then maybe, well, not till next year, they may have to start lowering rates. So we'll see. I mean, again, this has gone on longer than we thought already, but the economy's been strong. It remains strong, but it's clear that there's things that are happening that are starting to slow it down. So we
Good
feel
point.
like it's going to start slowing down here. There's a number of reasons why we put that in here to read, but I just feel like we're not going to cut anytime soon, in this year for sure, but maybe a couple next year. So we'll see. We'll see how it plays out. I'm not worried about that so much. I think what's nice is to have the opportunity with the higher yields to be able to put some money to work, in the bond market, and definitely for stocks, the dividend side of stocks, look to be
Hmm.
really attractive in here. Again,
Yep.
dividend paying stocks, or definitely need to have a portion of that in our portfolio. So yeah, it's going to be interesting to see what happens, but we feel like it's going in the right direction. And it's going to be just higher. We got to get used to that. I guess the wild card right now is still fuel. We talked about that. The
Yeah.
cost of oil, we're up in the mid 90s now, and that's going to go higher. I think gas will go higher because, again, yeah, it's
Production.
supply demand. You got to have
Yep.
more supply. We were energy independent a few years ago, and now we're getting energy from all kinds of other countries that don't like us. And so
Russia,
yeah,
Venezuela. Yeah.
it's just ridiculous. But and that's going to work its way, and I think that's another reason why inflation will going to stay higher going forward here.
And 2%. Good points. Yeah, I mean, I was looking at a chart today. Permian Basin is where they actually have the most oil drills, refineries, right? And oil drills and platforms, and just production across the board has decreased. They're not drilling in new areas. They're shutting down a lot of the refineries and oil fields.
Hmm.
So that's also putting pressure on prices. And like you said, that's not going to help it get to 2%. That's why we've
No,
we've kind of adjusted our estimates a little bit higher
yeah,
at this point. So, but I want to talk about what you mentioned, rate hikes. So we talked about how we think there's probably at least one more rate hike of 25 basis points potentially, obviously depending on data, but potentially one more 25 basis point rate hike here this year. And then next year, the markets are pricing in, I believe it's around 50 basis point rate cuts later in the year, later 2024, second half of the year. But I think people lose sight of kind of getting past the short term, right? Obviously,
no,
cash is king in the short term, right? You can get 5% on a money market account. There's, I think 19 trillion some odd dollars in money market / short term maturity type bills. So let's talk about this chart. I think is great, and you can probably talk a lot about this. But let's look at the results after the last Fed rate hike. So you look at the bond market 1 year following the final rate hike, 10.1% if you're invested in the ag, 7.1% 5 years after the final Fed rate hike. S&P 500, so we talked about equities having that long-term mindset. Over the long term is kind of what you got to look at. Could be short-term volatility, but long-term, 1 year following the Fed rate hike, 16.2%. 5 years, 9%. And then 60-40 blend, which is our traditional retirement portfolio, which got absolutely waxed last year. A lot of people weren't able to retire, or recent retirees who are growth with income, which is typically your 60-40 Warren Buffett portfolio, right? It really got hammered pretty bad last year because it was the worst bond market we've ever seen. Equities were down, bear market territory, over 20% losses. And so even with that type of portfolio, you're looking 1 year out 14%, 5 years out 8.4%. And then this is kind of proof in the pudding. You talked about short terms, increasing duration. Maybe you can talk a little bit more about that as well. But 4.7 to 3.2, 1 to 5 year for the 3-month T-bill. So thoughts?
Yeah, I think it's so. This just shows the value. I think right now, again, we talked about the cash on the sidelines. You see that to the far right. The U.S. 3-month T-bills. You know, you can get them at 3%. Annualized right now. 5%. To where that's a really incredible opportunity just to be able to be paid for waiting. But I was on a call yesterday, and again, reminded of how it's good to be getting that money right now in a short duration. 3 months, 1 year. You're getting 2 years. You're getting good returns there, or good. You're getting paid pretty well to have your money short term, but like this chart is saying on the far left here under the ag, is basically as once they start pausing, once interest rate hikes slow down, it's going to be more and more important to get not only the yield but the capital appreciation in the higher or longer duration. And that's all
Mm-hmm.
this graph is saying, is that you want to be, as an example, the 3-month T-bill is very short duration. Okay, so it doesn't benefit when after rate hikes, okay, or rate pauses, excuse me, after the Fed pauses, it doesn't benefit as much as the higher or longer duration areas do. So on this call, they were actually really talking about in regards to how we're going to have a window of time in here the next 3 to 6 months to really start to go out as investors on out on the duration scale in order to take advantage of what we're seeing in this chart. Okay, so
Yep.
sitting cash feels good, feels safe. I'm comfortable, but the point is, you're gonna, if you stay there too long, and even what I'm doing right now in portfolios is dollar cost averaging into more duration over the next few months here to be able to take advantage and make sure we get not only the yield but the capital appreciation when yields start to come back down. So feel like that's a real opportunity, and that's exactly what this chart is showing, is that
Yep.
again, you got to think longer term. You made the point earlier, we got to think long term, and that's longer term is getting capital appreciation on top of yield, and that happens out on the curve further. So we got to work towards our portfolios having some aspect of it in those longer duration areas.
Great examples. Great examples. And I think investors need to hear that. I think they need to think again beyond the near term, again, have a long-term mindset, but also just being smart. And again, that's where your advisors come in, your financial planners come in, is to help you position and think beyond the human emotion side, or, oh, what's going on now? We're going into presidential election year. There's a lot of uncertainty, right? But like, hey, like we've been through pretty much everything out there: terrorist attacks, depressions, recessions, earnings growth, earnings, contractions, companies going under. We've been through the best and the worst. So again, being able to decipher and wade through the noise and the mess is kind of what we do best, and helping our clients achieve their goals. So any closing thoughts to the closing bell here before we let our listeners and viewers go?
Well, yeah. I mean, I think again, you said, oh, I've been through a lot of cycles, since being an investor in the mid '80s, in college, and then, or my first job, and then, get into this business in the early mid '90s. Been a lot of ups and downs. And I would say this, that I guess if I've learned anything in the whole process, it's like, I just sum it up. This too will pass. So this correction, this pullback, all these things, the things, all the news and everything that's out there, we'll get through it, and we'll it'll pass. And so you just want to stay in the game. We talked about that, I think last week. You got to stay in the game, and make adjustments, but you got to stay in the game. And that's something that we always stress here, is not panic your way out of anything. So that's what I've learned out of this is, stay in the game, stay diversified, stay balanced, and you're going to be just fine.
Love it. Well, thanks so much, Mark. Again, always great doing these with you. We'll kind of keep morphing and evolving these things as we see fit. But I think there's a lot of good info that you shared today, and we'll see
Likewise,
you guys next week at the closing bell. Thanks, everyone.
God bless.